So market news today is that the median U.S. home price just passed $400,000 for the first time ever, according to data from the St. Louis Federal Reserve. In the third quarter, the median price hit $404,700, jumping nearly 13% since the third quarter of 2020, when the median sales price was $358,000. Now, we know this is an eye-catching number, but we know the market's been hot, lack of inventory, high demand, so we've seen this rise in home prices. According to a recent note from Goldman Sachs, home prices could rise another 16% by the end of next year. Now, a Goldman economist pointed out that all of the pandemic shortages, the housing shortage, might last the longest and that a crash is very unlikely, which we've been talking about. According to the latest forecast by Fannie Mae, median home prices are expected to rise another 7.9% between the end of this quarter, the fourth quarter of this year, and the fourth quarter of next year. Morgan Stanley showed that the country needs as many as 1.5 million homes to get back to normal and for the pace of real estate to get back to where it needs to be because it's years behind. Now, the housing shortage has contributed meaningfully to the record pace of home appreciation and the shortage we're experiencing. Now, while the magnitude of the shortage described above means it's unlikely we're going to find ourselves with an excess of supply at any point in the near future, the pace at which the supply is contracting has slowed. Another bump in inventory that people were expecting was foreclosures, especially after the forbearance ended. That hasn't been the case. Even if default rates jump up, there are too many companies that are sweeping them up from the banks directly to make a difference in our inventory. Hedge funds with $20 billion in investments bought up property in the last 20 months, which is a lot of the reason the buyers have had a lot of frustration in purchasing through regular financing. Only 1,400 homes are in default nationwide with Fannie and Freddie Mac. This is very low. It's great for the economy, but it doesn't help the inventory that the buyers were expecting around this time. Most Americans have kept their mortgages current in spite of the pandemic, which is great. Again, just hasn't helped inventory as many expected it to. Vacancy rates are the lowest they've been in 30 years, since 1978. Normally, banks have trainings for BPOs and forbearance loans, but instead they're selling to hedge funds and not gearing up for excess bank-owned properties, which is what we normally see in the market after a bank forecloses on a home. Hedge funds are snatching up inventory once the banks have foreclosed on them or homes are going into default. They're getting them before they even hit the market. So all of that to say, don't anticipate a spike in inventory. If you're on the fence about buying, don't be. Home prices are going to go up, and so will interest rates, which are going to make homes even more expensive than they were this year. Additionally, if they do go down or stabilize, interest rates are still going to go up and still making the home buying experience more expensive in the long run than if you were looking for a property at this time. If you are actively in the market looking for a property, find one, get one, negotiate one, and get one under contract. The interest rates right now are so low, it's going to save you money than if you were to wait for later on in the year of 2022 or towards the end of the year. 2023, we are anticipating 2 interest rate hikes. So it's definitely going to make a difference in your monthly payment.